I have 4 children, 2 of which are working adults now. And they came to me and they asked me, Dad, what should we do with our money? And what I would do is I would come up with a simple way to build a diversified portfolio of fairly low risk, solid companies for the long term. And that conversation evolved, and it evolved to the point where I realized that I could actually take some quite sophisticated financial and investment techniques, but turn them into a fairly simple, practical method that even my own adult children could use.
In coming years, the UK faces serious financial and economic challenges. Our government debt is too high, our economic growth is too low, our promises to pensioners are unaffordable, and our politicians are either clueless or helpless. How can investors navigate that sort of a future and still find opportunities to grow their wealth? Well, you might want to lend an ear to someone who has an award-winning track record of doing just that. I'm joined today by Southbank Investment Research's Investment Director, John Butler. John, I want to start this interview by going through some of your history so that people can appreciate why we're doing this video and what you bring to the table. We're going to get to some of the details later and how they might apply to investors today. But let's start the story with what happened back in the 90s for you when you brought some ideas out of the world of academia and ivory towers to financial markets in the real world.
Well, I entered the financial industry in the early 1990s. I got a job working on Wall Street for a company known as Bankers Trust, which would eventually be bought by Deutsche Bank some years later. But Bankers Trust was known at the time for its innovative use of certain financial practices, certain financial theories, but then applying them to real world trading, hedging, and portfolio optimization. And I specialized in all of the above to a degree, but really it was the portfolio optimization where I spent the most of my time. And the idea was that you could take what were already some well-established academic financial methods and apply them to real-world trading, risk management, and portfolio construction. And so that's where I entered the business, and I developed my skill set in that area, looking across financial markets. I worked on foreign exchange, interest rates, equities, commodities, and combined portfolios of all of the above, applying these methodologies, in particular, risk-weighted optimization, a methodology that in fact went from being kind of a really innovative new method to apply to investing when I entered the business to being actually very common and widely used by the 2000s.
And the basic idea of these theories is that if you analyze investments in isolation, that's one thing. But what you really need to do when you're an investor is analyze how different combinations of investments combine with each other to produce an overall effect of how much your portfolio might grow, how much it might go down in a crisis, how much of it is income, how much of it is growth. What is the overall combination? And I think really the claim is that the total can be greater than the sum of its parts, right? That you can create some value by combining things in the right sort of a way, a bit like a chef might cook a dish.
Yes, very much so. I mean, it's frequently said that diversification is the only free lunch in investing. That is, you want to combine assets in a way that extracts a little bit more expected return for a little bit less expected risk. And there's a concept called an efficient frontier on which you want to be invested to maximize your diversification benefits. I mean, look, if we always know which stocks are going to outperform, then to hell with diversification, just buy those stocks. But for most investors, the reality is you're going to get some things right, you're going to get some things wrong. But the one thing you can, in theory, always get right is to have an optimally diversified portfolio up to a point. I mean, you can't get into hair splitting here. And indeed, if you sail too close to the wind and leverage up what is supposedly a perfectly diversified portfolio, you might go the way of long-term capital management. So, look, I mean, there is a limit to what even diversification can provide. But what you do want to do is try to operate as close to that limit as reasonably possible.
Yeah, and the idea of the risk weighting and the optimization is you don't want to diversify just for the sake of it blindly. You want to be very careful about what combinations are actual diversifications and what is not.
And what you find is that some of the conventional wisdom around diversification, in fact, isn't true. So let's look at a contemporary example. The fact is the S&P 500 index in the U.S., which is a form of a global benchmark, has been doing very well over the past couple of years. But really, that's due to the performance of just 7 stocks. And so really, in terms of how much diversification are you really getting in the S&P today when 7 stocks are driving the market either up or down, most recently down?
Sorry to interrupt your video, but if you're enjoying John's analysis, you might want to know that he's identified the 7 UK stocks that could pick up the mantle from America's Mag 7. As you've probably heard, those 7 US stocks were behind the US stock market's meteoric rise over the last few years. And lately, they've been behind the crash too. We believe a select few companies on the UK's stock market could emerge as the next leaders. To find out which stocks they are, click on the link in the comments section or the description of this video below. You'll be able to download our free report there.
And so the idea that you're really getting a diversified portfolio just by currently investing in the S&P 500, maybe you're not, even though it contains 500 companies. Whereas also sometimes you can look at stocks and bonds. Normally stocks and bonds are not highly correlated, but sometimes they are. And so is a portfolio merely containing stocks and bonds truly well diversified for the long term? I've done extensive research concluding that it absolutely is not. And that, for example, you should add gold and precious metals to a portfolio of stocks and bonds to put it on a more efficient long-term investment frontier.
Which, of course, is complete blasphemy if you ask any academic today. But let's not go there. You won an award. You were part of a team that won an award for developing investment strategies and systems you still use today, which is what we're going to get to. Take us through what that award was for and how that system and trading methodology was then adopted by institutions around the world.
Well, the award was from Institutional Investor magazine, and it was an award for European investment strategy generally. That is, think macro strategy. It wasn't an award for stock picking, but it was an award for the method and the processes whereby one goes about implementing kind of a big picture grand investment strategy for European financial markets. And the reasons cited by the clients, the customers, the investors who voted in that survey was that it had a lot to do with the investment processes. When you work as a strategist for an investment bank, you're expected to come up with trade ideas. But I relied primarily on investment processes and systems to come up with those ideas. And so I would explain the process to the client. And then when a trade idea came out of the process, they'd understand how it was generated, where it came from. And I would always sell not just individual trade ideas, but I would sell portfolios of ideas that were designed to diversify one another, at least somewhat efficiently, if not always in a fully optimized way. It wasn't applicable to everything I did. And so that helped to differentiate my work from just a strategist who just is feeding random trade ideas here and there, now and again. It was much more systematic, much more process driven. And in my experience, when you work more systematically and more process based, you build a stronger relationship with your client. And I think that helped a lot in that regard.
It also allows institutions to think about managing their own money in accordance with this overall system and strategy. And that's what happened, as I understand.
Yes, that's right. That's right. I was part of this generation of strategists who really did roll out across most financial markets these types of methodologies. It wasn't just me, but it is something that became increasingly common. And in fact, some of the most successful investors in the world today have relied very heavily on these sorts of methodologies. Take Bridgewater, one of the largest hedge funds in the world. It's famous for its so-called risk parity model, where they use very, very sophisticated financial mathematics to make their overall positions within the firm as efficient as possible. Individual portfolio managers and traders, they can do their own thing all day long. But all of that is then funneled up into this mass optimization that adjusts those positions to be risk parity weighted. And so it's become a very successful concept in the industry.
So my dad went to university and studied information technology in the age when academia was leading the industry. And he was very successful in the same way you were, by bringing sort of ideas from academia that he learned and studied into the world of computing. And so it sounds like you did much the same thing. I'm very jealous because when I was at university, finance was very much behind what was going on in financial markets. And what we learned was basically proven to be completely useless by the 2008 financial crisis, which you predicted. So take us through what occurred then, because I think this is a pretty important point to understand for our viewers, that you're not an insider's insider.
Well, what we've discussed prior is regarding financial investment diversification and optimization methodologies, and I did learn that as part of my academic background, and as mentioned, my very first job on Wall Street was working in that area. But also, I have a background in economic history, and that includes the history of financial crises. And as we got into the mid 2000s, I started to see a lot of things going on that were eerily reminiscent of factors that had led to financial crises in the past. I had also lived through the long-term capital management blow-up of 1998. I had lived through the dot-com blow-up of the early 2000s. So I had some direct personal experience also of what were relatively small financial crises when compared to 2008. But of course, some of the historical ones that I had studied were substantially larger. So it became my view from about 2006, mid 2006, that we were going to see a very large financial crisis, most probably precipitated by a seizing up or decline of the U.S. housing and mortgage market. And I started to issue warnings, specifically at Lehman Brothers, where I was employed at the time, warnings that basically went unheeded and contributed to my decision to leave that firm in mid 2007, because I thought it was becoming an increasingly dangerous place to work. And I said this to my boss the day that I walked out the door to go to Deutsche Bank instead. He asked me, "John, why are you leaving?" And I said, I gave him three reasons, a couple of which were more personal, but one of those reasons was I believe this firm is dangerously exposed to the U.S. housing and mortgage market. And he just shook his head and said, "No, our risk management's way too sophisticated for that. You shouldn't see that as a reason to leave the firm." Well, 1 year later, guess what happened? So anyway, so I did have the ability to not only think in purely financial mathematical terms in my career, but to think more historically and more qualitatively. And that did help me to see 2008 coming.
And you subsequently set up a hedge fund, which was an interesting time to do so because the financial crisis was followed by the European sovereign debt crisis. So a uniquely difficult time to try and manage a fund and the investments in it. Take us through the impossible task and how you managed it.
Well, what I did was I sort of assumed that out of the rubble of the financial crisis of 2008, 2009, there was going to be demand for advisory services and an actual investable fund that was specifically designed to basically look longer term at history, at financial crises, and invest in a way that had inherent protection and diversification against those sorts of events. And so I founded my company, Amphora Capital, and provided advisory services to high net worth individuals and family offices, but some of them did want an actual investable fund. And so I set up a fund. And the point of the fund was to blend precious metals investing and commodities investing more generally with traditional financial portfolios, stocks, and bonds. Because one of the biggest lessons of 2008, 2009 is that all financial assets become correlated when you get worried about big defaults in the financial system. Ultimately, every financial contract, be it a stock or a bond, requires some sort of counterparty behind it and some provider of liquidity for the cash flows that accrue to that asset. And when those things come into question, then oddly, commodities, which are normally seen as riskier than financial assets, become less risky because physical commodities don't default. And so were ways that I came up with to blend in that commodities exposure to traditional financial portfolios that would make portfolios more robust to another possible financial crisis in future. At the same time, I actively traded around what I saw as some big investment themes at the time. That is, the European banking system, I felt, was fundamentally, irreparably impaired following that crisis. And yet lots of accounting shenanigans and hocus pocus were being used to cover up just how big the black holes were. And so the fund also systematically shorted European financial sector debt in the years immediately following the crisis. And the performance of that part of the strategy was quite good.
And this is especially relevant because I think we're facing a similar situation in the UK today. So your ability to manage capital back then through the European sovereign debt crisis might become useful in coming years. What similarities do you see today in the UK compared to when you were managing that hedge fund in Europe in the early 2010s?
Well, sadly, there are indeed some similarities. For example, you have a banking system that is still very, very reliant on leverage and very, very reliant on mortgage originations. And of course, the hope that the mortgages that aren't originated are going to become non-performing. But you have a very fundamentally weak economy now. The UK has been in stagnation for years. The growth rate of per capita GDP has been extremely low. So you've been excessively reliant on low-skilled immigration just to try and squeeze out a tiny bit of growth over the past decade. That is not sustainable. And yet the UK has run up huge debts, public and private, on the back of that. And the hope that those debts will be serviceable without resort to devaluation. That's a very dangerous game to play. And so, in my opinion, you are in a situation now following a period of very strong performance by the major UK banks, where the outlook is now dangerously weak. That is, I think the banking sector might be in for a major correction following its banks. If you take a capital weighted index of UK banks and financial institutions, it was up over 60% last year. That's a huge performance. And I believe that is an accident waiting to happen. If you look at the performance of real estate investment trusts in the UK, they did terribly over the past year. That's highly unusual. One of those two sectors is wrong. And I believe I know which one is wrong. It's the banks. So I'm currently in my investment strategy staying away from UK financial institutions.
Yeah, it's starting to sound very familiar, an echo from history from what happened 10 years ago. So let's turn to the investment strategy you pioneered and developed, which got you through that period successfully. It's all about the ideas of risk-weight optimization. So take us through what this strategy is, how it works, in just sort of a brief overview, first of all, before we dig into each different element of it.
Well, what you do for a risk-weighted optimization is you need to define your universe of investable assets. And what I do in my Wealth Advantage service is I use the FTSE 100 index, so the companies that comprise that index. I then approach it top down by breaking it up into sectors, of which there are 12. And then what you do is you take a look at all the historical volatilities of those sectors and their correlations vis-a-vis each other. And then you do a so-called matrix multiplication of the volatilities and the correlations. And what that will do is that will tell you, based on history, where you want to be overweight and where you want to be underweight in order to have the most efficiently diversified FTSE 100 portfolio possible. However, while that is the purely mathematical engine component of the investment process, there is also a process whereby you make adjustments. One adjustment is for where you are in the business cycle, which I divide up into 4 phases, and I look at how each individual sector has performed on average in each of those 4 phases. Those phases are recovery, expansion, slowdown, and recession. So you choose one of those 4 phases, and then you adjust your optimization process accordingly. And then finally, you overlay what you believe are non-cyclical investment trends. That is, trends that should result in high returns independent of where you are in the business cycle. So for example, one trend that I've emphasized over the past year is defense. I felt the defense companies would strongly outperform as a result of, well, what is a kind of a very unpleasant state of affairs in much of the world today, and the glaringly obvious need for Europe in particular to rearm, given what's been happening on its eastern frontier. And so that's an example of a theme that should not be primarily dependent on the business cycle. So all three of those stages of the investment process result in what should be a portfolio that is optimally diversified for the given macro thematic environment at the time.
Yeah, so that's a unique combination of using mathematical analysis of diversification, macro ideas, and I suppose the investment cycle, or the business cycle, I should say. So let's look into each of those separately. So you've got what you call super sectors, these 11 sectors. Take us through sort of what that is, because I don't think everyone intuitively understands how you might want to sort of slice and dice the FTSE 100 into different sectors.
Well, the sectors have different risk return characteristics. Some are very cyclical, that is, they're volatile with the business cycle. Others are much more defensive. So cyclical sectors would be things such as materials or basic industrials or consumer discretionary. Those can be highly cyclical. But also highly cyclical are financial institutions, in particular the banks, real estate, and also you find that technology is surprisingly cyclical. Many people think that technology just goes up in a straight line. It doesn't. It's actually a very cyclical sector. Whereas defensive sectors would be consumer staples or energy. You always need energy, regardless of whether an economy is growing or not. And also, for example, utilities. You always need to keep the lights on, regardless of whether an economy is growing or not. And healthcare. People are going to get sick regardless of how well the economy is doing. So these are things you look at the properties of these sectors, you look at their volatilities, you look at their correlation to the business cycle, you look at their correlations vis-a-vis each other, and then you know how you should be allocating across them in principle for any given macroeconomic environment. But even better is to churn it all through a risk-weighted optimization. And that gives you that extra diversification benefit.
Yeah, let's get to that next. The thing to emphasize first, though, is that these different sectors can perform surprisingly differently. So they can diverge to a surprising extent, which is really the advantage that you're trying to capture here, right? Being in the right place, right time.
That's right. Many people are surprised when they look at the numbers. The FTSE 100 has an average annual volatility of around 15 to 20%. It's in that sort of range. But the divergence in performance between the top performing sectors and the worst performing sectors in any given year is more on the order of 50%, twice as much or even more depending on the year. That means the potential to outperform the market by getting the sectors right is bigger than the potential to outperform just by going long or short the overall market. So the outperformance potential is substantial. Now, of course, the underperformance potential is substantial too. But if you use those sector differentials and the volatilities and correlations that are associated with those, if you use those to optimize your portfolio, there's a lot of potential diversification benefit to extract there.
Another way to think about this is that avoiding the worst performers is just as useful as investing in the biggest gainers, and like moving between the different sectors within the FTSE 100 is basically what allows you to do that. So the next part of the analysis is to take into account what you call mega trends. So you're not just sort of blindly diversifying, you are introducing some of your own opinion and analysis on what is going on in the world. Take us through how you do that.
Well, this is where I put on my hat, having a background in economic and financial history, because sometimes you spot something which is an emerging trend, which clearly is not going to be strongly related or correlated to the business cycle, and yet is investable in some way. And I mentioned defense a few moments ago as one that I believe was important when I launched the service back in 2023. But another one you could mention that we're also focused on is the energy renaissance. And we've gone through a sustained period of attempts to wean ourselves off of carbon emitting sources of energy. those attempts have basically overpromised and underdelivered. And now we're in a situation where we discover we've underinvested in traditional energy capacity and power generation capacity. That's an investable theme. And it's an investable theme that we've also have in the portfolio as a mega trend, if you want to call it that. And then finally, there's another one, which is simply prioritizing income over growth. That is a defensive investment theme, but it's one that is very applicable, I believe, to the world that we are in today. That is, we're going to see investors increasingly favoring cash generating, income generating companies over those that promise long term growth through some sort of intangible asset valuation that implies very high long-term growth as opposed to any real hope for near-term cash generation. So that's another mega trend that is expressed through the portfolio today.
So having established how these sectors are related to each other and which mega trends are actually playing out there, you run your risk-weighted optimization to establish how much of each sector you want to be owning in order to have this ideal optimized portfolio. But what is in that portfolio varies depending on what sort of phase of the business cycle the economy is in. So take us through what those four different phases are and how you determine which one we are currently in.
Right. Well, there are a number of indicators that give you a picture of which of those four phases that you're in at any point in time. They don't allow for precise timing, right? They're not going to give you daily or even weekly indications. They change slowly month to month, quarter to quarter. But if you are willing to be a medium-term investor as opposed to a high-frequency trader, they are suitable for that purpose. And they indicate whether you are in a recovery phase, that is coming out of recession, an expansion phase where you're well out of recession but continuing to grow, a slowdown phase where that rate of growth is declining, and finally, the recession phase when you slip back into a recession. And yes, you can take a look at 60 years of history. Actually, it's more than 60 years of history that I use. And you can look at all of those sectors, cyclical and defensive. And you can see how each one has performed on average in each of those four macroeconomic environments. And then you run that is desire to be not in a sector or in a sector for that given macroeconomic environment. You run that through your risk-weighted optimization, and it gives you a specific weighting. We do, however, work in round numbers. That is, if it gives you a weighting of 3.76, we'll just round it up. And if it gives you a weighting of 17.2, we'll just round it down. So we work in round numbers. Otherwise, you get into spurious accuracy, and the danger there is you begin to believe so much in your model, you start to lose judgment. So we do force ourselves to work in round numbers to avoid falling into that hole.
So this has allowed you to identify how much of each different sector you want to own in combination, but which specific stocks you want to buy within that sector is the next and final step. So take us through that one.
Yes, that's where you take a look at the sector components. And some sectors have lots of sector members, others have only a couple. For example, the FTSE 100 has only 2 technology companies in it, and it has only 2 energy companies in it. BP and Shell, as it happens. Big companies. So in some cases, what you're going to own in the sector is almost determined by what is available. In other cases, you can pick and choose. And when it comes to picking and choosing, we use very traditional financial ratios to decide. That is price earnings ratios, price to free cash flow ratios, enterprise value to earnings ratios. There are a number of very classic ratios that we use to select which companies we're going to hold in a given sector. And so that allows us to make a judgment on where the best value within a given sector is. It's no guarantee you're going to pick the best performing companies in a sector, but it at least makes it likely you're not picking what might be the worst performing companies in a sector. So you can get, now the alternative would be to buy every company in the sector. The problem with that is that you start to get into an unwieldy portfolio size. We don't want our customers to have to be monitoring 40 or 50 positions at any given point in time. We aim for 10 to 20 positions at any given point in time. So it's a more practical, easy to implement portfolio.
So the way I think about all this, to kind of summarize it, is there's lots of people who are value investors. There's lots of people who are macro sort of hedge fund type people. You've got the diversification mathematical side, and then you've got the traders, and you're sort of combining all four into one investment strategy so that no one of them can sort of let you down wildly, right? Because you're not allowing one particular sector to outgrow too much. You're still using valuation to determine which particular stocks within the sector you might want to buy. You are allowing for macro themed investment ideas such as defense stocks, gold, and things like that to play a role. But none of them sort of outweighs the other one. And that, as far as I can tell, is quite unique.
Yes, well, the strategy is intended to be a relatively safe place for investors to hold the bulk of their investable portfolio. It's all liquid companies. They're all UK listed companies. The volatility of the FTSE 100 index, as I mentioned, is around 15 to 20% a year. We aim to take no additional risk. That is, we're aiming at the same level of risk, but we're seeking to extract higher returns. That's the mission of the service. And as you say, that's why we incorporate all these various approaches to investing. We're trying to get an edge on the market in more than one way, but in ways that do not materially increase the risk of the portfolio. And in fact, since we started running it, we've had a less volatile portfolio than the FTSE 100 index, even though we have held only between 10 and 20 companies at any point in time. Our realized volatility has been lower than all 100 companies in the FTSE 100 index. So far, at least, we're delivering on that mission.
Yeah, and you're not pushing the costs of diversification into an unreasonable level. People aren't owning 100 stocks just to match the FTSE 100. You don't need to. That's the point of the strategy. You have been using it for your own investing, and I think you've been passing it on to your family or trying to figure out a way to do so.
Well, when I developed the Wealth Advantage strategy, I did so with just a typical UK saver and investor in mind. And I have 4 children, 2 of which are working adults now, and they're able to save money. And they came to me and they asked me, Dad, what should we do with our money? And I basically said, well, what I would do is I would come up with a simple way to build a diversified portfolio of fairly low risk, solid companies for the long term. And that conversation evolved, and it evolved to the point where I realized that I could actually take some quite sophisticated financial and investment techniques, but turn them into a fairly simple, practical process that even my own adult children could use. And that is essentially what Wealth Advantage is. And so, yes, in a very real way, I'm personally invested in this, myself and also my children.
And I've heard some rumors that you're considering turning this system, this life's work that you've pioneered and that you're deploying for yourself and for your family into a book to try and share the message and the method. Is it true? Are you considering it? What's the expected date of publication, if it is true?
Well, we're living in this age now of people publishing fairly short books. That's kind of the trend nowadays. Obviously, a novel might be somewhat different, but when it comes to practical matters, the short book has become a very popular format. And sure enough, I decided that was an appropriate thing that I could do with the entire Wealth Advantage process. That is, my background and experience, which elements of that I draw upon, how I derive the process, how I designed it to be very simple, practical to implement for a typical UK saver and investor, and how, in fact, I specifically go about it, how it is being implemented through the service. I decided that was sufficient material for a short book. And so, yes, I'm working on that now. There's not a hard deadline, but it's a big enough project that it does need a certain amount of project management. But I do hope to have something out within the next couple of months.
It sounds good to me. Well, John, to summarize here, I can't say I'm not jealous because you basically had the career path that I would have liked to have had if 2008 hadn't come along and robbed me of any job offers that I might have had. So it's exceptional to work with you instead. It's as close as I'm going to get. I don't want to go work for a bank anymore, that's for sure. But I hope you've given the viewers here some valuable ideas of what goes on inside the banking world that they can actually take out for themselves and make useful for themselves as they try and figure out how to deploy their own capital. John, thanks for coming on and taking the time. We're looking forward to the book, and to everyone at home, thanks for watching. Over the last few years, 7 US stocks have left the wider global stock market for dead. It's proof that you have to be in the right place at the right time to make real money from investing in shares. Investors who didn't own the Mag 7 didn't make much money, and those who owned a disproportionate amount of them made a lot more money than their peers. That's why you need a real strategy like John's to help guide you into the right sectors at the right time that will outperform, and also away from those that will underperform. But where will the next Mag 7 come from? In this report by John Butler, you'll discover why we believe they'll be found in the UK, and which 7 stocks are most likely to become the UK's Mag 7. Click on the link in the description below this video or in the comments section to get access to that free report right now. Thanks for watching.